Good morning, it's Jeffrey Christian from CPM Group. I'm joined today in our Future of PGM seminar with Rohit Savant, our Director of Research and Precious Metals Research, and our Chief Author of most of our precious metals research. He'll come in later and talk a little bit more specifically about the markets and for PGMs. I will say that there is a question period. Our hope is to run a presentation for about 40 minutes and then go into about 20 minutes of questions. The presentation that we have looks like it's going to be a little bit more than 40 minutes. We're going to be talking about the short-term and the long-term issues that are facing the precious metals markets, our PGM markets in specifically. But there is a question panel that you can type in questions. Carla Sanchez, one of our analysts and the Director for Asset and Commodity Management Services, will moderate the question period when we get there. We want to thank our sponsors and also acknowledge our media partners and distributors. The sponsors are largely the people who sponsor our Platinum Group Metals Yearbook each year. Grid Metals Corporation and Group 10, both Canadian registered exploration companies with very interesting PGM properties. Kitco Metals, we have Umicore and Sabin, two of the largest precious metals and platinum group metals refiners and smelters. Kitco, I mentioned, Noah Capital Markets, a South African institutional investment broker, and Monex Precious Metals, one of the larger and longest running precious metals retail outlets in the United States. Our media partners and distributors include Prospector News, Introact, Metals Daily, Corlin Economic Reports, and the Mining Network. So we want to thank them for supporting this program. So why PGMs and why now? We'll talk about that a little bit. Talk about the short-term PGM market conditions and the long-term market conditions. Why PGMs? Well, if you look at last year, it was a fascinating year for Platinum Group Metals. Obviously, we were still dealing with the lockdown and the recession and then the economic recovery and the expansion in China and the United States. We had the auto chip shortage, which interrupted auto production and sales. Auto catalytic converters being the largest end use for platinum, palladium, and rhodium. Platinum and palladium and rhodium prices rose sharply to record levels in the first half of 2021. And then they've plunged sharply. I'll show you in a second. Platinum prices, which have been range bound primarily between $800 and $1,000 an ounce from 2015 through 2020, shot up to almost $1,300 and then came back down below $900 by the end of the year. Now all three have recovered since then a little bit, but you've had this incredible volatility of record prices and record declines in prices in these markets. There are other factors. The world economy and the world political environment has a degree of uncertainty, both in terms of where we are today as well as where we're going over the next 5 years and 30 years, that will affect PGM markets. You also have a global auto industry, which is undergoing a massive transformation, and there are tremendous questions about what the future of motive propulsion technology is going to be. All of those factors then factor into the PGM markets, which have their own questions about mine production, smelting, refining, semi-fabricators, and industrial users. There are a lot of short-term shifts in the PGM markets, in the auto cats, where we're seeing auto companies shift back toward using more platinum at the expense of palladium because of the price differential. It's taken years to emerge because of the re-engineering issues related to shifting from palladium to platinum. Those were starting to appear in 2020. They've been kind of masked by the chip shortage and problems in the auto production, but they are continuing. And then there are these long-term risks. Will electric vehicles replace ICE engine vehicles burning petroleum products? And those are really some of the big key issues. Now, a lot to talk about in 40 minutes. And I was saying to my colleagues that I think that what we're going to try to do is say very little about a lot over the next 40 minutes. There are a lot of topics. The uncertainties that are facing the PGM markets are far greater than some of the commentary that you see in the PG markets and the auto industry would have you believe. And I think if we're successful here, what we'll do is we will drive home to our viewers in this program that there are tremendous uncertainties on the short-term and the long-term basis that will be affecting these markets. And if anybody tells you X, Y, or Z with any degree of certainty, you really owe it to yourself to check that out. Why PGMs? Why now? Again, producers, processors, semi-fabricators, users, they are all looking at major capital investments that may be required if you're going to continue burning petroleum in ICE engines, or may not be required. In addition to that, there are other major capital investment decisions that have to be made if you're not going to be burning as much petroleum or no petroleum. And we don't think that that's going to happen for at least the next 30 years. And we'll talk about that. But there are major capital investment decisions that need to be made now because mining companies and smelters and refineries last for 30, 40 years. And they're being made in a period of tremendous uncertainty. And what we're finding is that all of the market participants are saying, not only are we wondering about the long-term PGM requirements in a period of transition to motive propulsion technologies that we don't know what the market share is going to be 10 years from now, 20 years from now, 30 years from now. It's all uncertain. And we also, in studying this, start saying, well, we're not even certain what the current and recent past supply and demand balances of PGMs were because of a variety of reasons in the market. And final reason for doing the timing right now is CPM Group just released our long-term outlook, Platinum Group Metals projections of supply, demand, and price to the year 2050. And we take our projections out to 2050, 28 years, as opposed to a more typical 10 years for our metals market supply, demand, price projections. We're taking them out 28 years because of the uncertainty about the transition to what motive propulsion technologies will be and what the market share will be between gasoline, petrol burning ICE engines, diesel engines, compressed natural gas, electric vehicles, hybrid electric vehicles, hydrogen engines. There's a whole mix of uncertainties there, and it's not clear what's going on. So we take our projections out that far. We've just released our long-term report to the year 2050. And so it's a good time to be out there. This is sort of redundant, but it comes back down to the one thing. If EV market share rises fast as some people say, platinum, palladium, and rhodium will lose major market share. And the demand for these metals will be hit. However, if EV market penetration is slower than many say and expect, there'll be a greater auto industry platinum requirements, palladium requirements, and rhodium requirements, possibly large and persistent deficits and much higher prices. And spoiler alert, Rohit will talk more about this. Our expectation is that you're going to be burning petroleum in a lot of vehicles 30 years from now and beyond, and you're going to need PGMs to clean that exhaust. Why palladium? As I said, palladium rose to a record high of $29.80, almost $3,000 in May of last year. And you can see it was a sharp spike up. And then palladium prices fell 48% between May and December. They got down to about below $1,500, if I recall correctly. And they've risen a little bit. They're about 2,100 now, but they are still down from their peak. And one of the questions is, where's that going to go? We have our views, others have theirs. Why platinum? Again, as I said, platinum, you can see, fell from 2011 down into 2015, early 2016. And then it traded basically between $800 and $1,000 for about 6 years. Early last year, actually starting in December of 2020, the platinum price started rising. It started testing that $1,000 ceiling, which has held for several years, broke above it and made a run almost to $1,300, came back off, fell below $900 in the middle of December, and now it's back over 1,000. Our view, by the way, is that we think that 1,000 will become the new support level and that prices will probably rise higher, but 2022 is going to be a year of transition. And then why rhodium? Rhodium rose to almost $30,000, which surprised a lot of people. You have massive shortages of material. You had the auto industry restocking after a disastrous 2020. And then the prices came off 62% to as low as $11,250 in September. They're up now, and there's upward pressure because you're starting to see auto production and sales rise. Why CPM Group? We started doing research, I did at least, in the late 1970s on PGMs. And we were working on a variety of issues, including electric vehicles. I'll talk about that in a second. We produced what a lot of people think is the first market PGM report. It was released when we were the J. Aron Research Department in May of 1981. I'm very proud of the fact that what was then Rustenburg Platinum, Impala Platinum, and the Soviet government all launched investigations to see where we got our information, because we published a lot of supply and production cost estimates. And the only way that we knew that we were accurate was that the major three producers launched internal investigations to see who was leaking us information. But we produced data going back to 1976, and we have been updating that data continually since 1979, 1980. And it has transformed from the J. Aron reports to the Goldman Sachs reports when we were there. And since 1986, when we left Goldman Sachs and set up CPM Group as an independent research consulting company that is not attached to a producer, a refiner, a bank, or a user, fully independent company, owned primarily by its analysts. We have been producing CPM Group's Platinum Group Metals annual yearbooks. We were producing quarterly reports from 1987 through 2000, into 2001. After 9/11, we got rid of the quarterlies and we just do annuals. So we're preeminently based to provide this kind of information. And when it comes to electric vehicles, prior to going to J. Aron, I wrote the book on electric vehicles in 1979, and I wrote a newsletter on electric vehicles in 1978. I was at McGraw-Hill at the time, involved in a variety of industrial newsletters and reportorial programs. So we've been following electric vehicles for 40 some odd years, and it's funny that we're coming back to it. A little bit on present conditions. There are various big issues. The shift in vehicle loadings from palladium to more platinum. There's also issues about rhodium and substitution or reduction of per vehicle rhodium demand due to the high price and tight supplies of rhodium, and some technologies that allow for some reduction, but not the elimination of rhodium in autocatalysts. And that's probably the biggest issue and the biggest area of uncertainties in terms of short-term issues facing the PGM markets. Supply also is a big question, and there are issues about how many of the production projects and development projects will come on stream going forward, and what will be future supply over the next several years. Inventories, how much metal is out there? CPM Group has been known for years for having data on estimates of above ground refined inventories of platinum. There's a lot out there. It's sterile in terms of its price effect unless it's in motion. And that goes down to the next factor, investors' postures. If investors are interested, they'll buy platinum and help support the price, if not drive it higher. If they're disinterested, they'll sell it, as they did in 2012, 2013, into 2014. And they can be just totally agnostic and not pay attention to platinum. One of the things that we think we're seeing is a shift back to interest in platinum away from palladium by institutional investors as well as individuals. Now, Commodities 101 says that you look at a surplus and a deficit as total refined production of the commodity less fabrication or consumption demand. In oil and agriculturals, it's consumption. You actually use the stuff and it's gone. In most metals markets, it's fabrication as opposed to consumption. You're using it, but it's recoverable to some extent. Some of it's recoverable, some of it's not. That's how you measure supply and demand. In the mid-1990s, the precious metals markets became clouded by groups that started adding investment demand or surrogate numbers for investment demand into their fabrication demand figures. And they did that to make a more bullish case. It started in silver, then it spread to gold and platinum and palladium. We're old school. Commodities 101, total new supply from mine production and scrap recovery, secondary recovery from scrapped end-of-life materials, less fabrication demand. If you look at the market that way, and you should look at the market that way, because you want to know, is the market in a surplus or a deficit based on people who actually need the stuff, not the discretionary investors. Investors want to know, is this market tight because industrial users are using the stuff and demanding more than is being refined? Then I'm bullish. If it's tight because investors are buying this stuff, I'm less bullish because they can walk away tomorrow. So Commodities 101, total supply less fabrication demand. And when you look at platinum that way, you've had large surpluses for most of the last 50 years. In the 1980s into 1992, 93, those surpluses were basically absorbed by South African platinum companies that would rather hold the metal in inventory during periods of weak market demand relative to supply than let it slosh around the market. And when we published that first report in 1981, the chairman of Rustenburg suggested to the chairman of J. Aron that they fire me. And the chairman of J. Aron said, why? And he said, because you're going to bring investors into the platinum market and destroy it the way they've destroyed the gold market. I said to my chairman, I said, you know, the price of platinum last year went from $200 to $1,000 to $350. Investors are already here. And he said, yeah, just ignore it. With the transition to a multiracial democracy in South Africa and changes in the mining laws and the government's attitudes toward mining, the South African producers stopped being the buyer of last resort. And that was okay because you had a tight market for most of the next 10 years. In the 80s, from 2002 onward, those surpluses were absorbed by investors for the most part. There was some investment absorption of inventories by mining companies and smelters and refiners, but most of it went into investor holdings. They started to get out in 2012, actually fourth quarter of 2011, and they've basically been away from the market ever since. So you've had a market that's in surplus, and we've had surpluses with the exception of the strike in 2014. Since 2015, we've had surpluses. They haven't been that great because investors haven't been bidding up the price and saying, I want platinum, I'm bullish on platinum. And that has kept the price in that $800 to $1,000 range. If investors now shift their attitudes, as they started to do last year, and they become more bullish on platinum, they will want more than 100,000 or 200,000 ounces of platinum a year, and that will drive the platinum price higher. So that's the key lever to know in the platinum market. The palladium market, we had massive surpluses in the Audis. They've basically been gone, and for most of the last decade, you've seen a market that has been very tight. Small surpluses, small deficits, but basically very tight. We had a larger surplus in 2020 when the world and the auto industry shut down. We went into a small deficit last year. But the palladium market has been tighter. And that's why the palladium price has gone from $180 an ounce to $700 an ounce to $3,000 an ounce. So you've seen that, and now you have the price consequences on fabrication demand in palladium. And with rhodium, you've had certain deficits for most of the period of time since the US auto industry started adding rhodium to its catalytic converters in 1980 for model year 1981 in order to meet NOx emissions. And CPM Group's estimate has been that we were running out of above ground inventories to compensate for those deficits, and that the price would have to rise sharply as a consequence. So the price went from $2,000 to $4,000 to $30,000 over the last couple of years, because the above ground refined rhodium just haven't been there. And there has to be an incentive to A, increase mine supply, B, increase recovery of rhodium from spent auto catalysts and old chemical catalysts and glass making equipment, and also to discourage fabrication demand and encourage substitutes and reductions in per unit use. So those are the short-term factors. The long-term factors, peak auto or not, there are a lot of people who think that the auto production and sales of automobiles are peaking now or last year or 2019, and that from here forward, global auto production will fall. CPM Group doesn't believe that, and you'll see that in Rohit's presentation of the second half of this seminar. We don't believe that. We expect the auto markets to continue to expand. There'll be a shift. You are seeing mature markets in North America and Europe, but you're still seeing strong demand from the emerging economies, India, China, Russia, other parts of the emerging economies. So you're seeing a shift in the auto markets and a consequent shift in the nature of the vehicles being bought and vehicle sizes. But there's a big question hanging over the market. Are we at peak auto, and will the auto industry decline? Then you have issues of what's going to propel vehicles. Is it going to be electric vehicles? If you talk to auto companies, and you'll hear a CEO say, well, we expect to have 50% of our vehicles electric by 2030 and 100% by 2035. But then you talk to the engineering people, they say that can't happen. And Rohit will talk about some of the constraints that we're facing. And then there's future sources of energy, which I'll talk about in a second, and what it all means for PGMs. So what part of motive power? You know, this hierarchy of questions. What will be motive power? How many cars will still be burning petroleum product? How many will be electric? How many will be hybrid? If it's an EV, what kind of battery? If it's a lithium-ion battery, what kind of lithium-ion battery? There's all of these uncertainties that have to be dealt with. That's where I'm going to turn it over to Rohit, and I'll let him pick up the pieces and go forward. See why I can't do that?
Thank you, Jeff. So I'm going to start here by talking about PGM fabrication demand. And most of this next section is going to be focused on PGM demand from the auto sector, primarily because of the outsized importance of this sector to PGM demand. So one of the pressing concerns market participants have when thinking about PGM demand is the impact of alternate auto technologies on the demand for these metals. The good news is that of all the alternate auto technologies that are being developed to kind of curb emissions, the battery electric vehicle or the pure electric vehicle is the only one that is really negative for PGM demand. All of the other alternate technologies, so whether it's a hybrid, a PHEV, a plug-in hybrid electric vehicle, a fuel cell electric vehicle, all of these to some extent use platinum or a combination of the PGMs. The bad news is that the BEV has the largest market share and of all these alternate auto technologies, and it's likely to keep that lead primarily because of all the effort that's been put behind developing this sector, both by government as well as industry. Now, when thinking, while we expect market share for BEVs to continue rising, I think one aspect that needs to be taken into consideration is the overall size and growth of the global auto market. And as Jeff just mentioned, CPM's forecast and expectations is that the global auto market will grow over the next several decades, which contrasts with some of the other forecasts, which some of them talk about peak auto, some of them expect that it's probably going to flatten over the next several years. In our forecast as well, we don't have growth as strong as it was in the past 30 years, but it is still a growing market. You do have strength coming in from developing economies, not so much from the developed markets, but more so from the developing economies. And keeping this forecast of a growing auto market in mind, not only are you expected to see more battery electric vehicles, but there will also be more non-battery electric vehicles. So hopefully this chart helps to illustrate that point, which is that the growing auto market still allows for a sizable volume of non-BEV sales, despite the growth in the BEV market share. So you've got BEV market share growing pretty strongly over the next several decades, but because you also have a growing auto market, there is a substantial amount of sales of non-BEV technologies, which is then supportive of PGM demand, which is something that would not be possible if we were expecting a peak auto or flat demand in vehicle sales over the next several decades. So coming then to BEV adoption, our adoption rates for battery electric vehicles are somewhat more conservative than some of the other forecasts that you see in the market. CPM expects about BEVs to account for about 58% of global passenger vehicle sales, with the rest coming from internal combustion engines, hybrids, PHEVs, fuel cell electric vehicles. And the reason for singling out BEVs is because, as mentioned before, this is really the only technology which negatively impacts PGM demand. The others, in some way or the other, are supportive of this PGM demand from the auto sector. So many forecasts that you see out there are looking at government targets and automaker targets. And we've also taken these into consideration, but we also keep in mind that a lot of these targets have been missed historically, and there are good chances that these targets are likely to be missed in the future as well, just because of the number of challenges that there are to this sector and to a greater level of adoption. So one of those factors that we think will hold back the pace of adoption is obviously vehicle cost. This has been a concern for the longest period of time. There still is a pretty substantial difference between the cost of a battery electric vehicle and a comparable internal combustion engine. Much of that gap has been filled and continues to be filled by government incentives. About 30 to 40% of the BEV's cost comes from batteries. And the cost of these batteries, while they've been coming down strongly and consistently over the last decade and a half, there is now beginning to be a expectation that you might see, at least in the short term, a reversal in the average cost of these batteries, which could be problematic because one of the main concerns, as I mentioned before, has been vehicle costs. And if you're going to see battery costs, even potentially rise a little bit, that could derail or limit the level of adoption. And it's worth thinking about it that even at current levels of demand, you're seeing the input costs go up for these batteries. So it's going to be a lot more challenging to meet those more aggressive EV demand projections, which will push up the cost of these inputs like nickel, cobalt, or lithium. And a sharper increase in battery costs would translate into higher BEV costs, which would then hold back the demand for these vehicles and the adoption of these vehicles. And there are numerous challenges to meeting this demand. So if you try to build mine supply to meet this demand, that's going to be something that takes a substantial amount of time to come to market. The alternative is to develop different battery technologies and to diversify from that point of view. And that's already being done. You're already seeing various battery technologies being developed, but commercializing them is a different story. And that is something that also can take an extremely long time to actually commercialize these various technologies that are in the pipeline right now. Additionally, the lithium-ion technology as it stands right now is, extremely competitive with most other technologies. And so this is something that's probably going to stay around for some time and possibly continue to create strains on battery prices. So some of the other factors we think that would hold back adoption is insufficient charging infrastructure. And this is especially important in the case of battery electric vehicles, just because they're completely dependent on just the battery and the battery being charged. So, one place where this concern is very visible is in the case of Europe, where you're seeing a transition away from internal combustion engines, but it's mostly towards hybrids versus battery electric vehicles. And that's primarily because of this relative lack of charging infrastructure across that continent. Another reason why we think that the level of BEV adoption won't be as high as some of the other projections you see in the market is because a lot of it is limited to just a handful of markets. So most of the focus right now and most of the demand right now is coming from China, Europe, and the US. But also within these markets, there could be some short-term concerns with regard to what demand would look like in the next, 2-3 years, at least. For example, in the case of China, you saw, a sharp increase in demand for battery electric vehicles. A lot of that had to do with the government incentives being extended. Those expire this year. So what demand would look like next year is questionable, in part because the incentives from the government would be missing, and in part because a lot of that demand would already have been pulled forward into 2021, 2022. So that's the case in China. In the case of Europe, as I mentioned before, a lot of the transition from internal combustion engines is going towards hybrids versus BEVs. And again, it is really the BEVs that hurt PGM demand, not so much a shift in demand from internal combustion engines to hybrids. So it's a shift towards the hybrids does not really negatively impact PGM demand. In fact, it has a very neutral effect. Sometimes it could even be more positive than the internal combustion engine. And then in the case of the US, the US is presently lagging both China and Europe. And despite government subsidies, you're still seeing a lag in demand in the US. And any growth that we expect to see is from a relatively low base when you compare it to Europe or China. Other developed economy markets, if you look at Japan or South Korea, those two markets are primarily focused on hybrids and in trying to develop their fuel cell electric vehicles. So again, not so much of a focus on increasing market share for BEVs. And then lastly, if you look at markets outside of this group, any meaningful adoption of battery electric vehicles would not, in our opinion, occur at least until the 2040s. We don't really see markets out of this group to be able to create any kind of meaningful adoption of BEVs. Another factor that is hurting or holding back BEV adoption is the dearth of low cost financing in developing countries, which is holding back the development of new energy projects. And this will cause supply side constraints, which again we think will push up prices and keep BEVs in general a little bit more on the expensive side, which again would hurt demand for these vehicles. And then lastly, you have even over the next several decades, large portions of the world's electricity we think will come from fossil fuels, which means EVs are basically shifting pollution from transportation to where electricity is being produced. So this could create a bit of a social backlash, especially among consumers who are buying EVs with the objective of preventing climate change. So that is something that could also negatively impact BEV adoption. And additionally, the shift towards producing more green energy, it's possibly going to also be slowed to a certain extent, because too quick a move can lead to inflation. So too quick a move away from fossil fuels, and we already saw this a little bit during 2020, 2021, where the move away from fossil fuel electricity production did cause problems for the prices of electricity. So the next couple of slides basically show sources of fuel sources for electricity production over the next couple of decades. And as can be seen, fossil fuels continue to dominate the scene. These are both charts which essentially provide the same picture. You are seeing an increase in the contribution from renewable energies, but oil and coal and natural gas are still pretty substantial sources of inputs for energy production over the next couple of decades. So coming back to PGM demand from the auto sector, while growth in BEV market share is expected to be a headwind to PGM demand growth from the auto sector, there are several other factors also we think that will influence the demand for these metals. And we think that platinum stands to benefit and strengthen the demand for this metal, is possibly going to increase over the next couple of decades, versus palladium and rhodium, which face some headwinds in terms of demand. So looking at the factors that we think will affect platinum demand, the increased use of platinum in gasoline autocatalysts we think is one of the most important sources of or one of the most supportive factors for platinum demand over the next several years. As Jeff mentioned, they've been working on bringing platinum back into gasoline autocatalyst, and we should see this being phased in over the next several years and showing up more strongly towards the second half of this decade. There's also a relatively slower adoption of BEV technology in trucks, which again is something that is supportive of platinum demand, just given how important commercial vehicles and trucks especially are to platinum fabrication demand from the auto sector. And then some of these other factors that I mentioned here in terms of market penetration outside of the handful of markets and the transition to hybrid vehicles in Europe, these are factors we think, which I mentioned before, we think will also be something that would support platinum demand in the future. Palladium, we think, stands to benefit from a lot of the different factors that support platinum demand. One important factor that is very supportive of palladium demand is that a large percentage of internal combustion engine, especially for passenger vehicles, is gasoline powered, and this is good for palladium fabrication demand, just because these catalysts are expected to continue carrying a large percentage of palladium in them, even with the reintroduction of platinum into these catalysts. Obviously, the reintroduction of platinum into gasoline auto catalysts will bite into some of the demand for palladium, but palladium still will be the primary component of these catalysts in the future. And then in the case of rhodium demand, while the factors that we think will support rhodium demand are very similar to what we see in platinum and palladium, one of the main problems for rhodium fabrication demand is the growing popularity of selective catalytic reduction technology, which really doesn't use any rhodium at all. So that is something that would hurt rhodium demand in the future. So then talking about fuel cells, the demand for platinum from fuel cells will depend on two things. One is the demand for fuel cell vehicles itself, and the amount of platinum being loaded in fuel cells. So let's start with demand for fuel cell vehicles. The problems here are much larger than what we're seeing in the case of battery electric vehicles. The cost, for example, the fuel cell electric vehicle is the most expensive technology, alternate auto technology, and hydrogen is the most expensive fuel being used to power any vehicle. And if refueling, if recharging infrastructure is a problem with battery electric vehicles, refueling infrastructure for fuel cell electric vehicles is an even larger problem. So while fuel cell electric vehicles have some positives, which are more positive than even battery electric vehicles. For example, they're greener than battery electric vehicles, and they refuel much faster than the time taken to recharge a battery electric vehicle. Those would be secondary concerns for consumers. The high cost and the lack of refueling infrastructure, both of which are factors which are probably going to take some time to get resolved, are likely to continue holding back demand for fuel cells. And then we talk about the amount of platinum being loaded in the fuel cell electric vehicles. So this has been declining over the past several years. It's down about 90% as of 2021 from 2009 levels, and we think that it would continue declining by about 60 to 70% over the next 10 years. So there is an expectation that the amount of platinum going into fuel cells will be down substantially. And so to offset this, you would require a pretty and for it to have a meaningful impact on platinum demand, you would require a pretty substantial increase in demand for fuel cell electric vehicle cars. And then there's the problem of substitution, where they've already developed a platinum-free fuel cell. There are concerns about its long-term performance, and therefore it's not been commercialized. But once that issue is resolved, if it gets resolved, then even if fuel cell electric vehicles become important in the future, it may not have much of a positive impact for platinum demand. So there's a lot of question marks when it comes to fuel cell electric vehicles and its impact on platinum demand. So with that, we move on to PGM supply. We think that over the next 10 years, PGM mine supply should increase. That's primarily got to do with the ramping up of production at some of the mines that came on stream in recent years, and the potential for a few new mines to come on stream later in this decade. Beyond the next 10 years, we see a bifurcation in platinum, palladium, and rhodium mine supply, with platinum and rhodium mine supply actually declining and palladium mine supply remaining fairly stable. So a lot of the new projects that are being developed are focused on palladium-rich ore bodies. And so beyond the next 10 years, we see this increased focus on palladium to help stabilize a long-term supply. However, in the case of platinum, a lot of the older mines, which either are expected to cease production or are expected to see production decline, those ounces are not likely to be replaced because of this increased focus on palladium-rich ore bodies in the new mines that are being developed. With regards to scrap supply, we see scrap supply for all three metals going up. Platinum scrap supply has been in a declining trend over the past few years. However, this reintroduction of platinum in gasoline autocatalysts should be something that helps scrap supply beyond the next 15 years. In the case of rhodium, there was a substantial focus on reducing, and is a substantial focus on reducing NOx emissions, which used a fair bit of rhodium in autocatalysts. So as that material starts coming back in, that is something that we believe will continue to support rhodium scrap supply. And then for palladium, the increased focus on recovering scrap from electronics and the large amount of palladium that went into gasoline autocatalysts is all something that would help palladium scrap supply over the next 10 to 15 years. So with that, I will pass this back to Jeff to talk about the next couple of slides.
Great, thank you, Rohit. And so hopefully you're seeing my screen. So CPM Group has a variety of services that we provide across commodities, precious metals, as well as other metals like manganese and molybdenum and base metals and energy markets. In terms of our PGMs, we have Precious Metals Advisory, which is a monthly report, platinum, palladium, rhodium, gold, and silver, has projections of our price expectations for the next 3 months and the next 8 quarters, as well as a lot of information. They're typically around 44 pages long, a lot of information about what's going on in these markets and what we think will be affecting prices over the next 2 years. Monthly report, Precious Metals Advisory. Our PGM yearbook comes out every year. We're going to release the 2022 report in June. I believe we released the 2021 report in early July last year. We're offering a deal for people who say, well, I really want a 200-page report on Platinum Group metals with all of the details and pages and pages and pages of information. On it now, if you order the PGM Yearbook 2022, we will send you the 2021 edition now, and then we'll send you the 2022 when it comes out with the updates. They are PDFs, they're ebooks, and they come, the last page says, if you run a printed version, take this to a copy shop that does perfect binding, and here are the specs. I'll jump ahead because I saw one of the questions which had to do with inventories. The PGM yearbooks and the long-term reports have information on CPM Group's estimates of above ground refined inventories of platinum and palladium. Obviously, a lot of this is secretive. Most companies and investors don't talk about how much precious metals or other commodities they own, but CPM Group has been tracking this since the late 1970s. And we have estimates that hold together pretty well. And we've had some corroboration that our data is pretty accurate from various entities that are involved in holding above ground inventories. That's in our PGM yearbooks. The other thing is, as I mentioned earlier, we have just released the 2022 edition of our Platinum Group Metals Supply, Demand, and Price projections to the year 2050. So that's available. And then we do a range of consulting, from helping people understand what's going on in terms of these markets to advising them on investing, advising them on hedging their exposure if they're a commercial entity, and in some cases actually managing both commercial and investor positions. So with that, I'll open it up to questions. We ran about 9 minutes longer than we wanted to. Carlos Sanchez is going to moderate the question session. Yeah, so Carlos, if you'll go live, we can start this.
Okay, we have say about 20 minutes for questions. So we'll start with the first one here. A question that's pretty relevant. It's more so it's what's happening in the with Russia and Ukraine and relations with the US. What could be the impact on supply of palladium due to probable sanctions on Russia?
I'll handle that one. As you can see from the chart behind the poster behind me, I studied Soviet and Russian history, political science, and economics in university, and have followed it closely ever since then professionally. Russia tends not to use commercial power as political power. And you could see this in the Soviet era, and you've seen it in the post-Soviet era. So if there were sanctions and people said, well, we don't want Russian palladium, the Russian palladium would go to countries that would probably not be involved in those sanctions. And it could be China, but it also could be a lot of smaller countries that would then pass the metal on. You know, the reality is that the auto industry, the semiconductor, electronic industry, and other chemical catalysts and petroleum refining catalysts need the palladium. They need to get it. And if there's a shortage, they will find a way. You know, in the Soviet era, the Soviets would sometimes face sanctions. And even when they weren't facing sanctions, they would ship metal into the Netherlands and into Ireland. And you would see in the United States, Japan, Switzerland, the United Kingdom, large imports of Irish and Dutch platinum and palladium and rhodium, which was Soviet stuff. So I think that if you do see a worsening situation and if you did see sanctions, the palladium would still flow into the auto industry and other industries that needed it one way or another.
Okay, next question. To what extent will recycling of PGMs affect supply and prices in the future? So could there be a point where new PGM demand for autos is fully supplied by secondary sources?
Yeah, the arithmetic of PGM usage in auto catalysts and then recovery of it basically precludes that unless you saw a massive decline in the number of automobiles being produced and sold. You know, the reality is that if you have the same number of vehicles or growing vehicle population, you're going to need fresh PGMs. But in terms of recycling PGMs from auto catalysts, there are a number of stages in which there are losses. So the only way that you would actually have a situation where you could meet auto demand with recycling of spent auto catalysts is if you have a contracting auto market, and not just a modestly contracting auto market, but a sharply contracting auto market. But let me ask Roa if he has anything he wants to add to that.
Hello?
Yeah.
Yeah, no, I would agree with that, what the points you just made, and at least our statistics do not show. I mean, we do have scrap supply rising in the future, but we don't see it being sufficient to compensate or cover demand from the auto sector, and that's primarily for the same reasons that Jeff just mentioned.
Question, Carlos?
Okay, next question. What's the probability of a breakthrough in new high capacity battery technology, and what could happen to prices?
Take this, Roa, or should I?
I mean, I guess you can. I mean, we've talked about a lot of different technologies being in place. I think solid state batteries is, if I understand this question correctly, I think solid state batteries is one of the technologies which is being talked about and is being considered as a replacement to lithium ion. I think there's a lot of different technologies that are being developed, but the amount of time needed to commercialize them is probably several years out.
Yeah, there's sodium batteries, molten sodium batteries, sodium ion batteries, calcium ion batteries, and a host of other battery technologies that are constantly being researched. A lot of those technologies actually were being researched in the late 70s and 80s. They haven't really reached a point where they're competitive with lithium ion batteries. If you look at lithium ion batteries, it's actually been a series of types of lithium ion batteries that have been developed and commercialized over the last 20, 30 years. And that, is like, as Rohit said, the solid state is probably the biggest issue, the biggest threat to existing lithium ion technology. But the solid state batteries that they're looking at are lithium ion batteries, but they're solid state as opposed to having wet electrolytes. So I think the probability in the next decade or two of a battery breakthrough is relatively low. We haven't really put a number on it.
Okay, next question. Does CPM also cover ruthenium and iridium in detail?
I'll talk about that, but also let me just back up. We are, as you can see on the screen, we will be having a future energy sources seminar. We've scheduled it for March 15th. And that will be, the working title is actually Energy and Metals. And we're going to be looking at energy markets. Rohit showed you a couple charts on future energy sources and the reality that the International Energy Agency, which is one of those unbiased research groups as opposed to a marketing group with some particular technology or axe to grind, the IEA says that by 2050, you're still going to have petroleum and natural gas as the two largest sources of energy for humankind. So we will be talking about energy and metals, and that will include some of the stuff that we've talked about here, the effects on PGMs, but we'll also be bringing in some people on manganese and on hydrogen and on a energy materials fund that we're working on launching in the first quarter of this year, which will have some special proclivities to it. In terms of ruthenium and iridium, yes, we do research on ruthenium and iridium. We have long-term projections on supply, demand, and prices for those metals. We provide them to our clients. We typically will, if a client wants to invest in the metals themselves, which really is what you have to do because there's no primary iridium or ruthenium producer per se, but you might want to invest in a company that refines that stuff from spent industrial products like crucibles. If you are interested in iridium and ruthenium and you want CPM Group's research and consulting services, we will only provide that if you also agree to use us as the commodity manager. And the reason is it's very easy to buy non-exchange metals, and you see this as ruthenium and rhodium and iridium. You see it with cobalt. We've seen it in bismuth and in other metals. It's very easy for an investor to call up a trader and buy the stuff. It's very difficult to sell it. And we've seen this in cobalt, and we've seen this in rhodium, where investors, not CPM Group clients, but other investors will buy this stuff. And then when they go to sell it, they really hit the market, the price falls sharply, and the bid-ask spread sometimes goes to 100%. So we don't want to contribute to the damaging of the market flows. So we say to people, if you want to invest in iridium and ruthenium or rhodium, and you want our advice and research on it, we'll only work with you if we can control and manage your position so as to liquidate it in a non-damaging way. And I will say this, we liquidated a very large rhodium position in the 1990s in a period of declining prices. And in each sale of those, each tranche of the sale, we actually beat the published market price for rhodium. So we got a higher price than the market was offering for our clients' liquidation in a declining market. So we have a certain expertise in these markets that allows us to be more facile than others. And that's the approach that we have.
Okay, next question is, besides the main current usages, might there be new sources of demand for any PGMs resulting from technological developments on the horizon?
We follow patents, and Johnson Matthey actually has a great PGM technology review that they've done for decades. And there's a tremendous amount of research into uses for all of these metals. And one of the issues that you'll find, and if you look at platinum, you can see that over the last 100 years, platinum has gone from industry to industry. So you'll have an established industry, they use the material, they grow in importance to the platinum market. And then there's a new use that comes along and bids the price up. But you know, the price, there's a great deal of price sensitivity. So you'll see companies develop new uses for platinum plating rhodium, iridium, ruthenium, and then they don't commercialize them because they feel that there's insufficient supplies to meet the requirements of their new material, or they think that they would drive the price up so high that it doesn't make sense. But there's a tremendous amount of research continually going on around the world into new uses. And you know, you don't know what those new uses are until you see them.
Okay, next question is, do you foresee a continuing higher costs of energy in the years ahead? And how will these higher costs impact prices, particularly the costs of PGMs?
Talk about the costs of energy and PGM production, or you want me to take this on the demand side more?
I mean, the cost of energy on PGM production is a pretty small overall cost to, if you're looking, I'm assuming you're talking about mining costs. And so energy costs are a relatively small percentage of that total cost. So it's not going to create a huge impact on the cost side. For example, in the case of South Africa, it's about 55% of the cost comes from labor alone.
Okay, related to that, what are the probabilities for reductions in South African PGM supply due to non-mining factors? For instance, labor strikes, wage negotiations.
Rohit, I'll let you take that one.
I mean, those are definitely important factors, and they've always been important factors in influencing supply out of South Africa. You have, you know, labor strikes, you have electricity shortages. So you definitely have those factors influencing mine supply out of South Africa, and I think those would continue to be an issue going forward as well. They've also been one of the main reasons why the investment in South African mining has been declining over the past so many years, which would have longer term negative impacts on supply.
Okay, another question related to supplies. Does groundwater and issues with permafrost represent a long-term threat to Russian palladium supply?
It could be,
Go ahead.
yeah.
I'm sorry.
It could be an issue going forward. You know, you did see some flooding at mines last year, and I think this issue of groundwater as well as melting ice is something that's probably going to be an ongoing problem, at least for the next couple of decades. So that is a threat to mining in these regions.
Okay, and then another question is, there have been reports that ore quality in South Africa, particularly UG2 mines, is it declining? So how do you see the impact of this on mine production, in particular rhodium?
So UG2 is actually good for rhodium, just because it has the highest rhodium content. And what we've been seeing is a shift from mining the Mirinsky ore to mining UG2 ore. I'm not quite sure what you mean by reduction in quality, but there's really been a shift towards mining more of UG2, primarily because of its greater palladium and rhodium content compared to Mirinsky. So part of that shift has to do with what we've been seeing in the prices of these metals over the past few years, and part of it has to do with a lot of the Mirinsky ore already being mined out. UG2 ore does have higher chrome content, which is why it was avoided to as far as possible. But it is the one that is being mined and focused on more now, given the prices of the of palladium and rhodium.
Okay, another question. How will CO2 reduction efforts impact mine supply leading up to 2040?
I'm not sure, Jeff, do you have an answer for that?
I'm not quite sure that it's going to have a major impact. You know, there are bigger issues with carbon dioxide reduction efforts. And one of the things that you're seeing across the mining industry is the mining industry is looking at ways to reduce their carbon dioxide output, as are every other industry. We're not quite sure how successful any of those efforts will be. When we look at carbon dioxide reduction, there are a couple issues that come up. One is with battery electric vehicles, and Rohit touched on this with his IEA slides about the sources of electricity. Electric vehicles, as the energy supply currently is and is projected to be, electric vehicles primarily they don't significantly reduce carbon dioxide output. They shift it from the vehicle site to where the electricity is being produced. And those slides from the IEA that show that you'll still have, petroleum as a major source of energy in 2040, 2050, suggests that you could have a backlash on a consumer level outside of China by people who are buying electric cars thinking that they're helping fight carbon dioxide emissions and climate change. And when they find out that that isn't necessarily the greatest, the impact of electric vehicles, you could see a reduction in electric vehicle issues. This ties in with another question which we've gotten, which is, have we considered green hydrogen economy and its impact on the PGMs? And yes, we have. And I'm very enthusiastic about the idea of hydrogen engines. You have to solve the issues of safely and cheaply shipping, storing, and distributing hydrogen. And there are technologies under development there, some of which we've been following very closely and trying to raise finance for in the past that could do that. And if you do that, the auto industry would be very keen on looking at hydrogen engines. But you still have to solve the source of, well, where are you going to get your hydrogen? Right now, most hydrogen is brown, and it comes from byproduct. It's a byproduct of natural gas and or petroleum refining. There are green technologies and blue hydrogen technologies that could solve that. And one of the issues that, this is a big issue that we're going to talk about in the metals energy and metals seminar in March, and I best save it for that for time constraints. But we have been looking at it. We've also been looking at nuclear power. You know, when I wrote that book on electric vehicles in 1979, I was criticized as being a shill of the nuclear power industry, which I was not. But the reality is that nuclear power is a source of energy that could help with climate change and carbon dioxide emissions, but there are tremendous social and political issues that are blocking that. And there's some very interesting technological changes in the nuclear industry that simply have been overlooked. So, but those are all issues best saved for the Energy and Metals Seminar in March.
Okay, that was around 20 minutes, Jeff.
Okay. Yeah, I think we should wrap up then. Thank you all for participating and listening. Sorry we didn't get to all of the questions. We may try to address some of them somehow in some other method. As I said, we do have this Energy and Metal Seminar coming up on March 15th, and you can plug in there and we'll continue the conversation because PGMs are critical to that relationship between energy and metals. Again, CPM Group has its Precious Metals Advisory Monthly, our yearbooks, our special reports, and a whole range of consulting. Contact us at info@CPM Group if you're interested in talking about any of them, or go to our website and you can probably order some of those reports online. Probably, I say in a British understatement sort of way, yes, you can order some of those reports online at our website. Thank you for being here and have a good day, have a good week, and hopefully we'll talk to you again in March.